It was a quiet day on Wall Street. We did have a little bit of an abnormality where we saw the Dow Jones Industrial Average be the only one out of the four indices to close lower today, just fractionally, but it was actually the only one out of the four to actually hit an all-time high along the way. The other ones rose today, but were still a little bit shy from their intraday all-time highs they set yesterday. So we'll take a look at all that, see if it means anything towards our posture. We'll also kind of discuss some market breadth. Today we had the NYSE market breadth be a little bit negative for the first time in about 9 different trading days there. And then we're going to get into our trade application example, where I wanted to focus on a stock that I feel has pretty decent long-term potential. We're going to do it through the options trade, but I want to kind of explain my thought process with a very well-known blue chip type of a company that's fallen on hard times, but might very well represent a little bit of a value right here. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's February 11th, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down to our description area and sign up for our email distribution list. We're also heavy users of Twitter. I would encourage you to click like and retweet whenever you see me post these Market Outlook related tweets, and appreciate those of you that follow me as well over at my handle at Brandon Van Zee. And by the way, thank you to all of you that wished me well with my birthday yesterday. It's a great community that we have here, whether it's at Market Scholars or just over there on Twitter itself. So thank you very much for that. And then last but not least, we do have a presence on Facebook as well. Feel free to join our group at that web address you see embedded in the logo in front of you. All right, let's go ahead and jump into our charts here. And as you can see, I've got chart 4B pulled up here in front of us. Before we get to the market action today, I did just want to quickly pull up the Market Watch tab. I've gone now to the visualize area of Market Watch, and then I've clicked on Visualization Index Watch, and then using the S&P 500 in this case. But I did just want to quickly point out that while the S&P 500 was up today, we actually had more decliners than advancers. It wasn't a blowout by any means, but there were a few more negative stocks here today than those that rose, 268 to 235. And so we've had a lot of really solid market internals here recently. This is a rare day where you could say that the bears kind of won from that perspective. Anyway, as I mentioned before, it wasn't a big deal, just something that is worth pointing out. As we look at the charts now here on chart 4B is what we're looking for is, are the trends still holding? And the answer to that is yes. At this moment in time, that seems to be the case. Now, as I mentioned in the intro, today was a very strange day in that the Dow Jones, which is the chart in the upper right-hand corner, was actually the only one out of these four that was down. Now, it was barely down. It was only down 0.02%, but that's negative nonetheless. And it was also the only one that has this yearly high tag listed here, and you can see the label over today's candle as well. All of these other charts, you can see the high label was over yesterday's candle, even though every single one of those charts actually rose today. So you don't see that too often, a little bit of a peculiar circumstance. What we really care about is how are the trends looking? And right now, the trends are still looking fine. We've got maybe a little bit of wear and tear up here, as we haven't really advanced much in the last 3 days or so. But then again, we haven't fallen, right? We haven't broken any major support levels or anything along those lines. And so all else being equal, the path of least resistance continues to be to the upside. You can see the background colors of all of our charts are this dark green color right here, telling us that we've got a strongly bullish intermediate posture. Remember that is kind of being painted by what is going on with this intermediate line that you kind of see in the labels down below. That's the green line on the market forecast technical indicator, which for those of you that are newer, depending upon which broker you use, you might not have access to that. Remember, the market forecast is something that is specific and unique to TD Ameritrade, which was recently acquired by Schwab. So if you're trying to pull this up on Fidelity or something like that, you're not going to have much luck there. But it's a technical indicator that allows us to kind of measure strength over multiple time periods, which is why we use multiple lines here. And the green line is kind of our default mode. This is the one that we kind of use to set our posture over a few months or an intermediate time period. If you want to be a little bit more active with your trading, like we do in my factor-based swing trading class, then we would use kind of the blue line. In fact, I got some good news to share on that front. For those of you that are in the premium subscription for us, you'll know that we use Telegram to send out our trade alerts. And so one of the benefits there is that you guys get to see what trades we're taking in our various classes, both myself and David. Remember that, of course, we teach these free market outlook videos throughout the week, but what we really put our time and energy into is our premium products in those classes. And one of the benefits you get as a premium member is you'll have an app that can tell you which trades we're taking along the way. And so yesterday I posted this factor-based swing trading trade alert where we bought 245 shares of CTLT, Catalent, rated around $117, exactly at $117 actually, to the penny, and we were shooting for this upside price target right here at 122.89. Well, lo and behold, we hit that today. That's a beautiful thing. Anytime we get into a swing trade and we are hitting our price target with under 1 day under our belt, we are very happy with that success. Remember, swing trading, we typically plan to be in a trade for about 3 weeks. Sometimes we'll do well, sometimes we won't, but we've had a really, really strong string of success here with our swing trades in that class lately, and this is just some icing on the cake right there. Also, I let you know what sort of trades that we're doing for the market outlook videos here as well. So the benefit of that for those of you that are premium members is many of you might not have the ability to attend David and I's classes in the middle of the day. You know, you might still be in your career and you might be at the office or whatever, but if you've got your smartphone, you have the ability through the Telegram app to receive the notifications as soon as we place the trades, and then also give you the heads up when we're closing down our trades and managing our trades as well. So keep that in the back of your mind. I do know that many of you take advantage of that already, but some of you might not have signed up for that yet. And remember, if you're not a premium member of Market Scholars yet, you can just go to the Market Scholars website and go to our pricing table to see what services we offer you. So the takeaway on this particular chart here is kind of status quo. There's not a lot I can add to what we didn't know already, which is we still have strongly bullish intermediate postures here. Nothing changed on that front. We don't have any clusters to discuss. We don't have any intermediate confirmation signals to discuss or anything like that. So it's pretty straightforward here today. We continue on with our strongly bullish posture. And remember, we've been strongly bullish for the vast majority of time here recently. In fact, I was just looking at the trades that I've done for the market outlook videos in the last 2 months, and we're making money on every single one of the trades that I've placed. Every single one has positive PL open. That's a pretty rare feat. Typically, when you're doing more active trading the way that we do in these videos, you're going to have some losing positions. But in this particular case, using the market forecast technical indicator as my guide, I was forcing myself to be more bullish than maybe I felt like I wanted to be in my gut, and that has paid off very nicely, as pretty much all of these are bullish trades. The trip.com was an iron condor, so that's more neutral, and then TLT was a bearish bond trade. But remember, bearish bonds can actually mean that we're bullish stocks in some cases, so I don't really look at that as a bearish trade. But otherwise, we've been doing really well here with all of the trades we've been placing when I've been doing the market outlook videos for you guys here recently. So let's keep up that pace and hopefully find some more winners for you as time goes on. Remember, if you appreciate the efforts that go into having David and I hunt down those trade ideas for you, we ask one simple thing out of you. Just click like for us on Twitter. Let's take a look at another chart setup here. We're going to look over here now at the 3 green arrows chart setup. And you can see that we've got green backgrounds on all 4 of our charts. And so that identifies what we call the 3 green arrows trading signal. In other words, what we're looking for there are 3 bullish technical indicators. We use the 30-day moving average as one of those three. We use the MACD histogram as another one of those three. And we use the stochastic as the third of those three. And if all three of them have green arrows at the same time, then the background color of the chart gets painted, and therefore kind of gives us that sensation that this is a better time than not to be putting on bullish trend trades. And I can certainly confirm that is the case for my top-down trend trading class that I teach on Mondays, where our account hit yet another all-time high here today. And it looks like if after hours is any indication, looks like we've got another winner in our portfolio here with Disney reporting after hours, and the stock was up about 3% the last that I checked. So it looks like we maybe have another winner on our hands there with Disney. We'll see how that shakes out tomorrow, but so far so good on that count. So trend trading has been a fantastic place to be operating here recently, and we've seen some excellent results from that. If you're interested in that, again, that's my Monday top-down trend trading class. This upcoming Monday won't be teaching it because we've got President's Day holiday here in the United States, but normally get together on Mondays, discuss which sectors are doing the best, which industries are doing the best, and then which stocks within those best sectors and industries are doing the best, and then piling into them. That strategy can work awfully well when the markets are behaving themselves as they have here recently. But right now, across the board, similar to my conversation on chart 4B, here on chart 4D, nothing has changed. We continue to have bullish postures even using the 3 green arrows system right here. All right, let's go ahead and now take a look at our 1040 crossover method. And as we pull that up here, not a lot to explain here either. It's the status quo. We have strongly bullish postures from a longer term perspective. Remember, on this particular chart, which is 4C, for those of you that are premium members following along at home, remember you get access to all 50, I think it's 52 of our customized charts now. On this particular chart, this is a kind of a longer term view. And so these will be 3-year charts we're looking at here. Each one of the candles will represent 1 week in time. And you'll notice that each of the 4 charts has a orange line and a blue line on there. The orange line represents the 10-week moving average. The blue line represents the 40-week moving average. And we use a philosophy called the 1040 crossover method, where we're looking for golden crosses on the upside or death crosses on the downside. When we're in a golden cross environment, the background colors of the chart will be green. And as you can see, that is the case for all 4 of our charts right now. No surprise. Remember, that's been that way for a long, long time. In fact, with the NASDAQ composite, that gave us a bullish crossover in May of last year. So we will likely have at least a 1-year run with the bullish crossover there, because I can't imagine this market melting down so quickly between now and May where you would see those moving averages cross each other on the NASDAQ. Then again, I have seen stranger things occur. After all, we just got done witnessing GameStop going from $19 to $500 back to $50 in a span of 2 weeks. So I suppose anything is possible in this market. But right now, it does appear that the trends are fairly well established. And again, the path of least resistance continues to be to the upside. All right, let me pop on over here to the internet briefly. I always like to get an opportunity to say thank you to those of you that help support this product on social media, in particular Twitter, since that's the social media platform I use the most. That's what I pay attention to the most in terms of results. And I'm always striving to try to get 100 or more likes on Twitter. Last time around, you guys came through for me with 109 likes there. So thank you so much for supporting this product. As I mentioned last time, as long as we're getting over 100 likes, I'm not going to question whether we need to do this video every day. We start getting less than 100 likes, then I'll start asking myself the question, okay, well, can we get away with doing it once or twice a week, right? So naturally, these videos take a long time for David and I to hunt down our trade ideas, to actually record the videos, to edit the videos, to send out the notifications and the postings and everything else that goes into it. So we want to make sure that our time is well spent. One way you guys can encourage us to continue with these free videos is simply click like for us on Twitter, which takes you less than 5 seconds. So I think you got a pretty good deal there, all things considered. Really appreciate you guys helping support us. Also, while we're over here, a reminder that David will be teaching his technical analysis class tomorrow. Remember, David is a chartered market technician. He is one of the most elite market technicians you will ever stumble across. His students have the great opportunity to learn from a true master when it comes to technical analysis. So if that's something that you strive to conquer in the years to come, I would invite you to become a premium member of Market Scholars and join David each and every Friday for those wonderful classes that he teaches. And if you're not a member of ours already, come over here to the pricing area and check out our premium 3-year full access area. In addition to that, I taught a class today called the Question and Answer class. David and I each teach one of these each week, so that way it's kind of like an Ask Me Anything session where our students can kind of tighten up their knowledge around certain topics and pick our brains as to what we think might be some interesting educational conversation. And so today we had an outstanding session, as we always do. Got a question about United Healthcare, got a question about L3 Harris, got a question about Lockheed Martin, got another question about a whole bunch of industrials, including Lockheed Martin and Emerson and 3M and Union Pacific and Honeywell, and an excellent conversation about how to narrow down potential choices to kick out of your portfolio if you need to do that. Also got a question on the new stock selector tool and how you can utilize the top-down trend trading watch list that's embedded within that tool to help you become a better trend trader on the weekends. Also had a conversation about Vodafone and Novartis, and just a general conversation about how to think about dividend growth investing when it comes to foreign investments if you are an American-based investor, and some of the pitfalls of that and also some of the upside potential of that. And then I also had a question about how to think about bond allocation for somebody that might be in their 70s or 80s. And so lots of great stuff going on there. As always, that recording is posted to our calendar for those of you that are premium members that want to check that out. Also, here yesterday, I updated the factor selector tool. So a quick review of that here will show you that we didn't really have much change on the bookends of the rankings. We still have the low size category as the leading factor in this market, and we still have the low volatility factor as the lagging factor in this market. We did have quite a bit of change in the middle rankings here. Value did get back up to the number 2 slot, slightly overtaking momentum, and then dividend yield went up slightly over quality. So in the end, not a major week of change, because we really want to know what's the leading factor right now. And you guys should not be surprised to learn that low size stocks continue to dominate this market. All right, let's go ahead and get back on track with some additional charts now. I'm going to come over here to do a little bit of 12 grid analysis for you. And I'm going to start with chart 5A. This is our asset class 12 grid. As we pull this up here, you can see that we've got 4 pink charts on the board. A reminder that the pink background charts will be charts that are considered to have a bearish intermediate posture right now. And so as we look at those, preferred stocks actually is a little bit of a change. You'll recall that on Tuesday when I did the video for you, preferred stocks had a green background. And so after a couple of sell-off days there in a row for preferred stocks, we are now trading slightly below the 30-day moving average, and the posture is now weakly bearish, not strongly bearish. You can see the intermediate line is at 56 and falling right here. So once that goes below 50, then that background color will turn that darker shade of pink. But right now, it's more of a chart that's just trying to figure itself out, right? You're looking at this chart, and basically for the last, let's call it, month and a half, the preferred stocks have effectively just tracked sideways. The market's had much more exciting areas to concentrate on. We also, in the exact opposite corner down here in the lower left, see that light pink background color on the US dollar. It's a pretty similar conversation to what I had with you on Tuesday, which is the US dollar has a weakly bearish posture, not strongly bearish, and you're at kind of an important level here. Hasn't really done much to bounce from that level, so I don't know what that means at this moment in time, but we're not far enough below the moving average that leads me to believe that it's not something that is in the cards. I think it's entirely possible that we could still get a bounce from the US dollar here. Now, as I mentioned on Tuesday, I'm somebody who believes the US dollar will fall over the longer term, but in the short term, it is possible that we've had a little bit of a bottom formation carved out here. And so we got to kind of take it on a day-by-day basis. And right now, with us basically hugging the 30-day moving average, we don't know what direction it's going to break. Is it going to break down and kind of continue that trend that was established at the end of 2020, or will we bounce up and off of that moving average to kind of have this new trend that was established in 2021? We'll wait and see on that. The other two pink charts are these two kind of in the middle rung right here, and they've been kind of the same old story, right? These are the ones that we've talked about endlessly as being bearish, particularly long-term U.S. Treasuries. Remember, we do have a bearish trade on that. Again, sometimes when you're bearish on U.S. Treasuries, that means you're bullish on stocks. And so I don't really call that a bearish trade per se. It's more so a trade where we want bonds to go down and hopefully stocks do well in that environment. And that's exactly what has happened here in the last several months. But, not much has changed here. We continue to be in a downtrend for TLT and the long-term U.S. Treasuries. It was down again today, about 0.5%. In fact, we might be rolling over here. We talked about on Tuesday how we had these oversold cluster signals that might lead to a reversion to the mean type of a move. We have bounced for 3 days in a row, and now today we're rolling over again. And if that's all it has in store, that's an awfully quiet whimper that it was able to put together. Usually when you have a reversion to the mean type of a move, you're going to have a little bit more aggressive action towards that moving average. This time around, we just simply aren't seeing that. And then foreign bonds hasn't been quite as bearish as long-term treasuries. Notice that the trend has effectively changed at the beginning of 2021, around right here, whereas we had that in place in the final few months of 2020 for U.S. government bonds. So this is more of a recent phenomenon, but nonetheless, what we have learned here in the last month and a half is that the path of least resistance for foreign bonds is now to the downside as well. In terms of our bullish charts here, Bitcoin had a heck of a day yet again. What else is new, right? Bitcoin sitting up here at around $47,000 or $48,000. Remember, ever since I put this on the chart here within the last month or two, it seems like the story's been mostly the same. Bitcoin, Bitcoin, Bitcoin. It is a speculative asset that is working very well. Remember, there's a very core demographic here that is very loyal to cryptocurrencies, that thinks we're going to have a major disruption to our financial system, and Bitcoin could very well be the answer to that, kind of a decentralized monetary system. And you're having folks like Elon Musk push that agenda higher and higher when his company Tesla decided to get involved and add some Bitcoin to its balance sheet. So a lot of positive vibrations going on there in the Bitcoin space. We were able to take advantage of an Ethereum trade here not too long ago. But for those of you that have additional cryptocurrency plays going on right now, there are some spectacular winners in that area. One of them I've brought up to you guys in the past is that MicroStrategy. And that stock has gone up hundreds of percent here in the last several months. And so it's just one of many companies that are kind of getting caught up in the hype of the cryptocurrencies. And who knows, maybe it's here to stay. Maybe this is a game changer type of technology. And maybe we'll be talking about those types of disruptive plays for years to come. So it's really exciting to see what's taking place in the cryptocurrency world, and Bitcoin continues to lead the way as kind of the torchbearer for that entire category. You'll see here at the top, we've got green charts across the board, whether we're looking at the U.S. stocks, whether we're looking at developed foreign stocks or emerging foreign stocks. Emerging foreign stocks continue to be the place to be. Notice that EEM is up 20% in the last 3 months. So there's some great opportunities there. Those of you that were in my top-down trend trading class on Monday know that we looked at some banking stocks in India and other places around the globe that have shown some strength, that are quietly getting more and more attention even by U.S. investors. So don't put the blinders on and just assume that the only great stocks are here on our shores. There's wonderful companies all over this planet, and right now is one of those places where you're seeing that outperformance is in the emerging markets. All right, let's go ahead and take a look here now at our sectors and see how they shook out for us today. So as we can see here, there's only one pink chart left on the board. That's on the bottom rung there. That is utilities. And even that's not all that terrible. You can see that the intermediate line is at 74 and falling. So in other words, weakly bearish, not strongly bearish. We remain above a rising 30-day moving average in that chart's case. But obviously it doesn't have as much oomph as a lot of the other charts that are on the board. I was talking to my class earlier this week about the sneaky move in real estate. We've had quite a tremendous push in a lot of those REITs here recently, so don't fall asleep on them. But the more consistent charts are kind of the ones near the top. Remember, those are your more cyclical areas of the market up here, where you're looking at something like technology hitting yet another all-time high today, up over 1%. One of the stocks, by the way, for those of you that attend my Monday top-down trend trading class, that doesn't get a lot of press, but is darn near a double for us all of a sudden, is Synapsys. So sometimes you get these sneaky little plays that are kind of embedded in the guts of technology. They're not the most exciting names that you talk about, like Apple Computer or something like that, but they can be effective investments as well. So anyway, a lot of good stuff coming there from technology. Remember, this is a market that is willing to take on risk right now. We had the Bumble IPO here today, and that was a very successful offering, and a company that's going to compete directly from Match Group. And you can see here Match Group would be part of the communications sector, and communications have been just absolutely lighting it up. Take a look. 1, 2, 3, 4, 5, 6, 7, 8, 9 straight days XLC has been up. So eventually that'll end, but that is quite an impressive move. 9 trading days in a row. Remember, that would stretch out basically 2 weeks right there for us. So there has been consistent buying pressure in those types of names that are out there. So Bumble was wise to be offering its shares to the public at a time when the public is obsessive over owning those kind of web-based companies that are out there. So those are a couple of the areas that really seem to be firing in all cylinders right there, communications and technology. All right, let's get into our trade application example for the day. And what I'm going to do in this case is pull up chart 2A. This is the dividend stair-step chart. This is what I use in my Tuesday morning dividend growth investing class. And I'm going to pull up a company that probably isn't getting a whole lot of attention, but I think is worthy of some consideration for long-term investors. Now remember, this particular video, the Market Outlook video, definitely caters to the active trader. So you'll have to forgive me because I myself am a dividend growth investor, and I just can't help myself. Got to share the knowledge every so often, even though I know the core audience of this video is active trading. But what I will say is that Kellogg is getting to be at a very interesting level for somebody who maybe is approaching this stock market for the very first time ever and saying, as I look around, I don't see any stocks that could be considered cheap. All stocks have just gone to the moon, as the kids are saying, right, over on Reddit. And that's the way it feels. You look at the market and there's, a marijuana stock that's gone to the moon, or a video game retailer gone to the moon. So it gives you the impression that there's not much value out there to be had. That might be true. There might not be much, but it doesn't mean there's no value whatsoever. And I do think that Kellogg would be an interesting pickup right here for somebody who's just starting their dividend growth investing portfolio today with the mindset that they plan on holding a stock for the coming decades as long as a company doesn't cut its dividend. So the reason that it caught my eye today does revolve around the market forecast technical indicator, which is why I feel comfortable bringing it up with you here today. And that is, you can see here on the weekly candle chart, we now have what's known as an oversold cluster signal on a weekly candle, right? So this, again, to stress it, is a 10-year weekly candle chart. So Kellogg is just ticker symbol K, nice and easy. And we've had quite the pullback here recently. Kellogg was recently trading up here above $70 just in the fall. So it's fallen from 70 down to 57 during a time when the stock market can't get enough of growth stocks. Kellogg is, of course, about as boring as they come for those of you that like Special K or, Frosted Flakes or what have you. Now remember, Kellogg owns a lot more brands than just the cereal aisle, but nonetheless, that's kind of what they're known for. And so they're a company that owns owns Pringles as an example of a product they own in the snacking aisle. But I feel like this company is kind of unfairly punished right now. They came out with their earnings today, and they might not have lit the world on fire, but they are expecting growth in the coming year. And as I look at the available merchandise all around me and I ask myself, where is value? This is one stock that could fall into that line of thought, as I was mentioning to one of the people that was asking me the question here on Twitter earlier today. You look at its PE ratio, it's trading at 14 times earnings. That's cheap compared to most stocks in the market. In fact, it's even cheap compared to itself. Down below here, you'll kind of see this brown line that plots the PE ratio for a company over the last 10 years. And again, this is part of our customized charting package. You will not find this particular chart setup anywhere else because these lines up here are proprietary to us here at Market Scholars. But anyway, down below here, when you're looking at the PE ratio, you will see that we are trading at basically the lowest valuation that this company has had, going back probably all the way to back here. It had this kind of little dip back in 2012. That's a long time ago, right? 9 years ago was the last time it was trading this cheap. It might have gotten a little bit down there here towards the end of, or the beginning, I should say, of 2019 as well. But the point is, you can see that we are at a really cheap level for this particular company compared to where it normally trades on a valuation basis. You'll also notice that in addition to having an oversold cluster signal on the market forecast, in other words, the blue, the red, and the green lines on the market forecast are all in the low reversal zone using a weekly candle chart at this exact moment in time. In addition to that, it's trading in what I call this blue zone right here on the dividend stair-step chart. In other words, when the stock is trading in the blue zone, it tells you that that is historically an attractive time to be buying the shares, right? In other words, you want to buy when it's in this blue zone over here. You don't want to buy when it's in the orange zone up here. This would be considered more overvalued. This would be considered more undervalued. And so clearly we are in that undervalued territory when we're using the dividend yield as our guide. Right now, it closed exactly at 57 to the penny, and that's exactly what it needs to have in order to have an exactly 4% dividend yield. So it's kind of interesting how it shook out that way here today. Now, it's not an aristocrat, the way that you hear me talking about some of the other well-known blue chip companies out there, but it does have a long history of raising dividends. It's in a period right now where it has kept the dividend the same at 57 cents per share. So I am hopeful that they'll eventually raise that later on this year. A lot of companies have frozen their dividend during this coronavirus environment. Now, freezing the dividend doesn't mean they're not going to pay it to you. It just means that they're keeping it at the same rate that they had it previous to the coronavirus. So they're still paying a very ample 4% dividend yield for people who buy it right now. And that's partially what I thought I would do, is just simply buy the stock. One of the downsides of that, from my perspective of teaching this presentation, is it does chew up a lot of capital. And I have to be kind of cognizant of that in the years to come. I can't just buy a whole bunch of long-term positions in this market outlook account because eventually I would run out of capital, right? There are ways that we can solve for that in my dividend growth investing class, but it's a little bit more difficult in this particular environment. So for those of you that decide you're just going to buy Kellogg right here at 57 and hold it for the next 10 years, I would fully support that. Obviously, it's not a guarantee, but it is the type of company that I think has reasonable value in this overvalued market at this exact moment in time. What I chose to do instead was a little bit different, and some of you might have caught it when I was sharing the Telegram with you, where basically I sold the $50 put on Kellogg, and this was the leaps out to January 2023. And I sold that for $6.30. So in other words, I took in $630 today when I took this trade. And I mentioned here on the Telegram itself, for those of you that are premium members, because I want to make sure that you're aware of this. This is not how I typically teach this particular trade in my Options for Long-Term Investors class. Normally what we do for these types of trades is focus on the next 20 to 60 days. So this is a little bit out of character for me to be selling a put on something that goes out a few years like we would with the Leaps contract right there. Now remember, for those of you that are newer to the idea of selling puts, it is a way for us to try to acquire a company at a much cheaper price. Since I got $6.30 when I sold that. So first of all, what I would do is get the $50 strike level, because that was the put that I sold. That's the strike price of $50. If I subtract out the $6.30 I just received in credit, that means that my cost basis, if I were forced to buy that out in 2023, my cost basis on Kellogg would be $43.70. Now, keep in mind that I expect them to raise the dividend between now and then, but let's say they don't. Let's just say that they hold the dividend at 57 cents. If we take 57 cents and take it times 4 to annualize that number, it's $2.28. If we divide that by what our break-even cost basis would be when factoring in the credit that we would just received of $43.70, you can see that our yield is effectively 5.2%. Rather than this 4% up here, we have the possibility of having a 5.2% yielder in our portfolio. And it's not like this is a company that's on hard times, right? This is a company that's still selling a lot of product. And so I don't mind that trade-off right there. Now, one of the things that I found interesting about it is when I come over here, and by the way, there were plenty of trades going off there. You got to be a little bit more careful on these where you go out so far in time, right? There's going to be less liquidity in those types of trades, so you should always be using limit orders when you're doing that. But there were plenty of trades going off today at $6.30, which is where we got filled as well. So if you really wanted it at that level, I think you could have received it. But anyway, when you're looking at that, one of the ways that I kind of think about it in my head is to do a little calculation. And we say to ourselves, okay, well, we got filled at $6.30. So in other words, $630 is what we took in to be willing to buy it at $50 if push comes to shove. So we took in $630 today. If I divide that by the amount of days we would be in the trade, 708, you can see here that we would make about 89 cents per day for our willingness to buy a stock $7 cheaper where it's trading right now, even though I think it's undervalued at this exact moment in time. So it's kind of a buffer, a further buffer, a margin of safety of sorts, just in case we have a major pullback in the stock market in the years to come, right? I did a leaps trade with you guys last year with the Discover Financial, and I gave you all the stats of why I really like that company. I didn't sell a put that time, I bought calls, and that turned out to be a tremendous opportunity that ended up quadrupling. But this is a little bit different because that was a different environment, right? When we were doing that last year, it was like in May when the stock market was low. We're currently in a stock market that is really high. The higher we go, the greater the chance is that there will eventually be a fall in the coming years before those leaps expire. And so I'm trying to account for that to a degree. And while Kellogg could very well be an interesting choice to buy calls on as well, I'm not necessarily as confident because the stock market itself is probably due for some sort of a legitimate give back at some point between now and 2023. So I kind of want to account for that along the way. And that's why I chose to do the selling of the put. But anyway, back to this concept that I was showing you a moment ago. We make about 89 cents per day when we're doing something like that. Normally, you are going to make less money on a per day basis by selling puts on those further out contracts like the leaps. But in this case, I also evaluated selling the $50 put here in March, the normal time period I would teach my students, between 20 and 60 days. There's 36 days left in the March contracts. Well, here, when I was looking at it when the market was open, we would have been able to get about 30 cents. You can see the bid and ask is 20 to 35. But again, focusing on the $50 put right there, we would have received $30 there. And we divide that by the 36 right there, which is days left, and we would have made about 83 cents per day. So you can see where that compare and contrast. Here, we would make 83 cents per day. Down below here, we actually make more, like 89 cents per day. Usually that's the opposite. Now, part of that story is because this is a high-yielding company. So remember, all else being equal, every time the company pays a dividend, its share price will go down by that much. So that explains part of that that discrepancy there. But just wanted to point that out because a lot of times when we make those comparisons, we see the opposite. We see that we make more money by selling the shorter term contracts, and we would have made less money on a per day basis by going further out. This one is kind of attractive because it's actually the opposite of that, and it's a stock that I have a decent amount of respect for, has a long history of paying dividends, and is a company that I don't feel like is going to be disrupted in a major way in the coming few years. And so I think it provides an all-around excellent margin of safety for people who kind of want to practice that mindset and see how it goes for their own portfolio. So I apologize for having such a lengthy conversation on this one today, but I did want to kind of explain myself because a lot of my students will say, well, wait a second, Brandon, that's not how you really teach us how to do this. And so I wanted to explain why this situation was just a bit different than a lot of the other things that we tend to stumble across when we're selling puts. So I hope you got value out of that additional conversation there. If you did, the one way you can help support this product as always is click like on Twitter for me. Remember, I'm at Brandon Van Zee, and this tweet will be pinned to the top of my timeline. So with that, I want to wish you all the best of success with your trades and your investments, and I'll see you all next week. Take care, everybody. Bye-bye.